Hi, my name is George Stagnino. I'm the editor of the Peter Dack portfolio. What I would like to do with this video is to show you some very simple indicators I follow and how they relate to our business cycle indicators that have a timing, unbelievable timing every 3.5 years. They are, by the way, derived from market data and how the economic data ties to the market data. Not only that, but also what I'd like to do is to make an extrapolation. Since the peaks and the bottoms of our cycle indicators follow every 3.5 years, I can project what the next bottom is going to be, and above all, what the next top is going to be. So let me show you what I mean in more detail. This is our, as you know, the business cycle indicator. What is important that I want to emphasize on this video is this is the growth phase one, and two is also the growth phase, but this is where the excesses are being generated, meaning rising inflation and rising interest rates. This is where the beginning of the correction, in other words, consumers' purchasing power slows down, business profitability decreases. So in phase four, there is the correction phase. Consumers will retrench until their purchasing power is reestablished. And then when that is done, it starts phase one. Why do we care about this? Because the investment strategy in one and phase two, as you know, is going to be more cyclicals. The stocks, industrial, financials, of course, technology, uh, commodities. And instead, in phase three and mostly in phase four, there are defensive sectors like staples, utilities, real estate, and bonds. So within that, in business cycle and in strategy framework, let's see now how the indicators, what kind of indicators reflect this uh, this pattern. I showed this in the Peter Dack portfolio, and it's an amazing pattern. By the way, all the data starts with 2011, start from 2011, so you can compare the various cycles. I'm not talking recessions and expansion. Within a long expansion, there are small business cycles that impact asset classes. So this is why I'm concentrating on these cycles within the expansion part of the overall business cycle. This chart shows the producer prices of card boxes, and obviously they are very sensitive to the business cycle. As soon as business strengthens, they buy business buys card boxes and prices go up. When business slows down, they don't ship so many goods, the prices slow down. And this is exactly what is happening. I focus on this patterns of growth, slow down, further economic growth, slow down, strong economic growth. Here there are a couple of ticks, slow down, and then start all over again. And now we are in the sort of a stronger phase of the business cycles, seems to be peaking right now. Why is that important? Because this, again, is one indicator. These are prices. I follow different types, so then I compare and try to get a picture of what really is going on. But then what this is saying, there have been this mini cycles, if you wish, but very important because here, as I showed in many articles and in my previous videos, here defensive sectors has outperformed the market. In this phase, cyclical sectors outperform the market. So what this indicators is saying, the bottom line is, look, George, don't think about recessions because business is buying card boxes and prices are going up. So this is not what happens during a recession. So keep that in mind. Another important indicators is the sales of heavy trucks. And as you can see, if you recall the previous slide, they follow exactly the prices, the pattern of boxes, of prices of cardboard boxes. Goes up, down, stronger economy, slow down. And these are the previous cycles, that the three cycles before 2020. and here there are some other cycles. Right now, what the sales of heavy trucks are saying, there's been a slowdown and they're still contracting. In other words, the transportation industry is in trouble because there are not enough goods to ship, and therefore people don't buy. Obviously, an operator doesn't buy trucks to ship because the business is very bad. What is interesting, this is contrast with the previous slide that instead prices are going up. And this is, I showed this data on purpose because nothing is clear cut. There is always uncertainty, and you have to make a decision based on probabilities. And this is where I am heading. So what are the markets saying about what I showed you? Well, the markets agree with the sales of trucks. Why? Because this is the transportation average. And as you can see, this is the relative strength, and beginning in 2021 has been going down. In other words, since 2021, the physical economy is not doing well. The electronic economy, the internet, the tech stocks are being doing well. But the shipping of goods, that part of the economy, is not doing well. That's why there is this dichotomy in all the data. And this is an important indicator because it confirms that with the transportation index underperformed, the economy is really not doing well, has not been doing well, has been deteriorating, and is not doing well right now. This is what one index of the markets is saying. So let's see what we can come up next. Okay, this is where the tire hits the road, I guess. This is the S&P 500. Again, since 2011. And this is our business cycle indicators. These are data computed solely by market data. So there are no economic data. This is how the market sees the business cycle. Okay? And of course, we developed in a proprietary way. Several things on this chart to think about. First of all, this trend line. This is a channel that went since 2011. The market has been going within this channel. What you should notice that every time the market hits the upper channel, the upper line, this trend line here, the market doesn't do much for quite a bit of time. And by the way, this is it touched in 2022, and 2022 is here, and since from here to April 7th, the compound annual growth rate of the market was 1.14% from this point here to this point here. So that tells you the importance of hitting this line. So now the market has hit again this line. So history shows that when you do this, then for some time the market has to rest. Keep that in your background. It's very important or not, I don't know, but it's something that is statistically significant. Let's put it this way. Now, but the important thing is the leading indicator. Again, the business cycle indicator. When they come down, like I showed you in the previous chart, the economy is slowing down. Defensive sectors are doing well. When instead rises, cyclical sectors are doing well. As you see, the turning points are exactly the way prices of cardboard and the other one I showed you, the truck sales, heavy truck sales. They both correspond to these curves. One important thing about this chart is from this point, from this peak to this peak to this peak to this peak, is roughly 3.5 to 4 years. So this peak was in 2024. So the next peak is going to be 3.5 years roughly from now. So we are in 25. It is going to be 2008 probably, 2007, 2008. The bottom is exactly the same thing. From bottom here to here to here to here to here is anywhere between 3.5% and 4%. The important thing of this chart is that we are hitting a bottom. This is very important because it says we are setting the stage for the next business cycle, and the upswing is probably going to last at least 2 years. The question, so we are at a great point here. The market is getting, the economy is getting to the point ready to jump. However, there are not the conditions still present, as I mentioned in the Peter Dack portfolio. What you need to establish this bottom here, every bottom has been preceded by lower inflation and lower interest rates, and they're preceded by lower commodities. This is not what's happening now. So what is my point? Yes, we are at let's say towards phase 3 into phase 4, but this bottom is not a buying opportunity yet. The buying opportunity is when the upswing on the upside, when interest rates clearly are coming down. Short-term rates right now at 3.8%, the 2-year yields. When that comes down to 3.53%, that's when the new cycle starts. Inflation is still rising. It was 2.3, now it's 2.67, some measures at 2.9. So this is not what happens. The money supply is still growing. So this is not yet a cyclical bottom. But when that happens, the next move is going to be at least 2 years. Like it happened from here to here. See, from a bottom to peak, from bottom to peak, from bottom to peak, from bottom to peak is roughly 2 years. So this is the investment framework that I'm trying to convey to you. The conditions are getting there, but they're not perfect. So the point is, we are at a great point in the business cycle. That's where you want. This is where is the time to be patient, wait for the conditions that are perfect. There is probably not going to be a depression, as people say. Actually, for people who follow my writing, I don't believe that that's going to happen. But anyway, we are getting ready, but we need to have, the picture has to be what has always happened at the bottom of our business cycles, which is short-term interest rates have to decline, inflation has to decline, and then you see the upswing into the next cycle, which should last easily for the next 2 years. Thank you very much for reviewing this video. I really do appreciate it. Hopefully you found something interesting and helpful for your investment strategy. Again, we have plenty of videos like this in our www.patreon.com/Peter Dack, dealing with all sorts of investment strategy issues. Again, thank you very much for being here, and I hope to see you really soon. So long. Take care of yourself.